All right. It looks like we have a good number of attendees, so I think without further ado, we can go ahead and get started. There is a lot of ground that we'd like to cover today. A quick few notes before we start. We are recording the webinar, and we will publish this as well as a transcript in about a week, so there will be materials. The participant chat and video have been disabled, but you can ask questions at any time. The questions will be visible to the hosts, and we will do our best to block off some time at the end to address those questions. As I mentioned before, if you have connectivity issues, please email Sam at reunioninfra.com. All right. I think to kick things off, it would be good to introduce our fellow webinar panelists here. We have Alex joining, Katie or Catherine from Baker Bots, as well as Brent. So maybe just going around the clock. Alex, if you would like to introduce yourself.
Yeah, thanks, Connie. Hi, folks. My name is Alex. I lead product and engineering for us here at Reunion. I also oversee the Reunion compliance business, which provides Reunion PWA, the software product and service that we're offering. We're also working on other things like FIOC, as well as beginning of construction compliance as well.
Great. Katie, if you'd like to go next.
Yeah, hi everyone. I'm Katie McKevely. I'm a tax attorney with Baker Bots. I practice in our federal income tax group, and I specialize in renewable energy tax credit matters. So I advise clients on prevailing wage and apprenticeship issues and domestic content, energy community bonus credits, started construction issues, and FIOC. I also advise on the transactional side, including mergers and acquisitions, tax equity financing, and tax credit purchases. Thank you to the Reunion team and looking forward to a good discussion.
Great. Thank you, Katie. Brent, if you'd like to go next.
Yeah, hey everyone, I'm Brent Sherratt. I'm with Clean Energy Counsel. I focus my practice on tax equity financing primarily, tax credit transfers, and really soup to nuts development, as well as M&A transactions in the renewable space. So happy to be here.
Thank you, Brent. And I'm Connie Churn here with Reunion. I will be your moderator today. I am head of transactions and finance. And what that means is I work on a lot of transfer deals. Prior to joining Reunion, my background has been primarily in renewable energy and other tax credit financing structures, having done public accounting in this space, tax equity in this space, worked with developers in this space, and also done investment banking. So been around quite a lot of these transactions, and I'm very excited to dig in today with everyone here on PWA and compliance. So without further ado, I think we can get into actually, before we get into that, let's talk about Reunion and just a little bit of background in terms of like why we've been a thought leader in this space and a lot of actually what Alex has been building out. Alex, if you could share a bit about this.
Yeah, absolutely. Thanks, Connie. So Reunion, effectively for folks that aren't aware, we're the leading platform for clean energy tax credit transfers and compliance. We operate really sort of two different business units, one on the tax credit monetization side, where we connect buyers and sellers of renewable energy tax credits. Since that business started, we've facilitated over $6.5 billion worth of transactions across a number of different technologies and almost every credit type. Through that experience, we saw that compliance was becoming a major issue for a lot of our developer customers, and we about maybe a year and a half, 2 years ago, started building the Reunion PWA platform, which really facilitates the ingestion of payroll data and apprenticeship data across the board, all the way down to sort of the smallest subcontractor and an EPC on a given project, ultimately automatically comparing that data to what folks should have been paid and what apprenticeship requirements should have been met, which we'll get into here in a little bit in some of these questions as we answer them. But we've had a lot of success on the compliance side as well, working with close to now 300 different project engagements and also close to 200 different compliance reports generated across around 500 different developers in our ecosystem. So excited to walk through some of the major questions that we've seen come up in both our transaction side of the business as well as in our compliance side of the business, and get Brent and Katie's expertise and view on some of these things.
Great. All right, so kicking things off, question number one, supplemental wage determinations. In what situations should supplemental wage determinations be requested? And once you get a response, what do you do? I guess, Brent, if you don't mind me tagging you in here.
Yeah, that's great. Yeah, so I think when you're beginning to start the construction process, first thing you should do is go to sam.gov, which is the Department of Labor interface webpage that has general wage determinations. And if there's a general wage determination for the county in which your project's being constructed, that's your guide for what the prevailing wage will be. And if that's not available, if there is no determination, no general determination for your county, then you can apply for a supplemental wage determination specific to the county. And the idea is that there's a 90-day requirement that you're supposed to apply for the supplemental wage determination 90 days prior to entering into the contract for construction. And then once you receive that supplemental determination, the wages paid to the workers on site there will need to comply with that prevailing wage determination. And that will be good for the life of the contract. So that'll be good throughout the construction period. If it's an EPC contract, if it's an O&M agreement, you can actually have a longer term to the contract. So it's really just whatever the term is of the contract, with some limitations there in terms of like you can't have like a perpetual option to renew it and keep the same wages in place for 10 years or whatever, if that's not consistent with the rules.
Got it. And Alex, are these common? I guess, do you see these a lot in your experience?
Yeah, we've seen customers requesting supplemental wage determinations fairly frequently, and I think one of the questions we get from folks is, once I get one of these, then effectively what am I doing with it, right? And I guess the obvious piece is now you're paying folks, against this rate that has been verified by the DOL, or at least confirmed. And one of the things that I like to mention to folks is that in Reunion PWA we do allow for the setup of these supplemental wage determinations and then ultimately the tracking against them. We'll ask for, effectively the DOL letter or the response that was given. But otherwise, we, recommend that folks obviously keep the record and then ultimately make sure that everyone, is aware that that this is what, folks working under this trade need to be paid going forward under this contract.
Got it. Well, Brent mentioned a 90-day window, but what happens if you don't get the determination and construction needs to begin?
I can take this one. So exactly. So a question of this kind raises a number of timing considerations, and the regulations have so many different timing rules on supplemental wages. So first, like Brent said, you have to make the request 90 days or less before you expect to enter into the contract for the construction work. And then once the wage and hour division receives that request, they're directed to respond to it within 30 days, or within that 30-day period, let you know that they need more time to consider your request. And then once they issue the wage determination, then that's good for a 180-day period, meaning within that 180-day period, you taxpayer need to start construction or enter into a contract for that construction work. So nothing in this timeline guarantees that you're going to have that determination at the time you're entering into the contract or the time that construction begins. So if you get that determination after construction begins, there is some relief such that if you make a payment like back wages to your laborers and mechanics within 30 days of that determination, then you are not subject to the penalty requirements. And as an added bonus, you don't need to pay those back wages with interest. You just get to pay it retroactively, just the bare difference between what you pay them and what the wage determination is.
Got it. And what are you paying, I guess, in the meantime?
It it doesn't matter, but I would recommend paying whatever wage that you request so that you can have some consistent reporting. But to the extent there is any difference between the wage you're paying and whatever is determined to be the correct wage, you just need to pay that in back wages within 30 days of getting your determination.
Got it. And I think that actually covers quite a bit of number 3, which was just changes in supplemental wage determinations and what happens if your response comes back and they tell you that you need to pay more than the rate that you indicated. So I think, Katie, please correct me if I'm getting this wrong, but it sounds like you pay the higher amount, and if you do that within 30 days, you can do so without additional costs.
Yeah. Two extra things on this. If you disagree with the wage determination, there is a process for appealing it. And what happens if you blow past your 30-day deadline? You get the wage determination, but you don't pay those back wages within the 30-day period. Then you're out of compliance with the prevailing wage requirements. You're subject to the normal cure and penalty payment provision. So in that case, you'd be expected to still pay those back wages eventually, plus interest, and make that $5,000 per labor per year penalty requirement.
Got it.
And a quick question on that, Katie. So if when does the clock start for the determining if the penalty needs to be paid in the case of a of not meeting that 30-day window, right? So if I don't meet the 30-day window and then now I have to pay my back wages with interest, typically the clock on, underpayment would be the last day of the first month of the quarter after the quarter in which it happened. Is that still the case in this case, or is there some other clock?
Yeah. Okay. So you're referencing one of a couple different exceptions that taxpayers are eligible for to be like a waiver of this penalty requirement. One of those exceptions is that if you, taxpayer, identify an underpayment by the end of the month for following the calendar quarter in which the underpayment occurred, and you correct it by the end of that month, and that underpayment is either small in amount or short in duration, and you do all that, then you're then no penalty applies to. You're raising a question that if you don't pay your laborers and mechanics back wages within that 30-day period, can you still correct it, provided you do that correction by the end of the calendar month following the quarter in which that underpayment occurs? I don't see why not. I don't see why this special provision, like this special rule on the 30-day period, has anything to do with the general penalty waiver. I would say that general penalty waiver still applies, but it's a broader penalty waiver. It's not unique just to this supplemental wage determination. It's more global.
Super helpful. Thank you.
All right. Number 4, exemption from PWA compliance. Are certain activities exempt from PWA compliance? Specifically also, what activities are exempt during the alteration and repair period? So I think this one, Brent, if you might help us break this into different periods of construction, that might be a good way to approach it.
Yeah, sure. So I think, in a big picture sense, there's kind of two very big exceptions that are always important to keep in mind. One is if you're less than 1 megawatt, then you're deemed to have complied with PWA. And the second one, if you had begun construction prior to January 29th, 2023. So I think we still are seeing some financings of projects that began construction prior to the PWA requirements. So they're obviously exempt. But the PWA generally applies to the construction, alteration, repair, but not to maintenance of a project. So that's an important distinction. Once the project's been constructed, your regular maintenance activities that are aimed at keeping the project in its existing state. So that's not improving the performance. That's not repairing a module that has been damaged, and bringing the performance back up to the original condition. But just maintaining the existing condition is exempt. Those activities are exempt. But also, it's important to note that once you achieve place in service, once the project has been initially constructed, the apprenticeship requirement no longer applies. And then importantly, and there were some questions in the final regs as to what actually constitutes an integral part of the facility. So if the qualified facility, if there's something that's not integral to the facility, then that actually will be exempt from it. And the most common example of that is an access road or fencing. And the other key test there is whether the activity itself qualifies for the credit. So if you don't actually qualify for the credit for the activity, then you don't have to comply with PWA for that.
What are the, I guess, gray areas around this? I think there are sometimes pre-construction or preliminary activities taking place. That's what comes to mind for me, but maybe we could get a little bit into the gray areas, Katie?
Yeah, absolutely. So I got asked a question recently. Does tree clearing work or other site clearing activity need to comply with PWA? And the site clearing work is quintessentially preliminary activity under longstanding guidance for establishing the beginning of construction for federal income tax purposes. So for everything other than PWA, you would think that site clearing, tree clearing, leveling the road, those are all just preliminary activities that aren't construction for federal income tax purposes. However, PWA is different. They don't define construction like we do for all other tax purposes. They have instead they cross-reference the definition of construction in the Davis-Bacon Act, which is way bigger, way more broad than the definition of construction we use for other purposes. And so for the Davis-Bacon Act, construction includes preliminary activities, or at least in the preamble to the regs, they say it's a broader definition, purposefully so. It includes and as an example, they say it includes removing a structure from the site. And then if you trace through the definition of construction in the DBA regs, it'll include excavating, clearing, and landscaping work. And so it seems to me that tree clearing and other sort of quintessentially preliminary activities are in fact construction, quote unquote, for purposes of PWA. And so I think you're well advised to, if in doubt, comply with PWA with respect to anything that could be considered construction on the site of the work.
All right, very helpful. And just a quick note on Q&A. At any time, feel free to drop questions in. We will try to work them in throughout where we can. We're also saving time at the end for additional Q&A. All right, I think we can move on to question 5 then. Apprenticeship requirements. How can developers be confident in satisfying participation ratio and other, for example, good faith effort requirements?
Yeah, I can take this one. Let's start with the participation requirement. So the apprenticeship requirements have 3 sub-requirements. One of them is called the participation requirement. This is a requirement that's intended to cause each of your employers that employs at least 4 or more employees to hire at least 1 qualified apprentice. I got asked recently from a client who had people going on site to do some on-site work that they knew was subject to PWA, and yet for this mobilization, they were going to hire like 10 employees, none of which were qualified apprentices. And they say, is this an issue? It's not an issue so long as this employer comes back for a second or a third or a fourth mobilization at some point during the construction of this project, and then they hire at least 1 qualified apprentice. So that the participation requirement is on an employer by employer basis, and at one time they have to hire at least 1 qualified apprentice, and it's not a per mobilization test. The next question is on the ratio requirement. This is the second of 3 sub-requirements for the apprenticeship requirements. The ratio requirement requires for each qualified apprentice that they are paired with a journey worker in a ratio that's provided by the Registered Apprenticeship Program. You can generally think about this as like a 1-to-1 ratio, just for example purposes. So if you are required to have however many apprentices on your project, then you need to make sure that those apprentices are working in the correct ratio, the apprentice to journey worker ratio. If you don't, there's no penalty per se for failure to comply with the ratio requirement. Instead, the ratio requirement impacts whether or not you satisfy the labor hour requirement, and it also has implications for prevailing wages. First, if you are out of compliance with the ratio requirement, you only get to count the hours of your qualified apprentices that are in compliance with that ratio requirement in the labor hours for your project. And then separately, if you're out of compliance with the ratio requirement, then those apprentices, like those extra apprentices, have to be paid prevailing wages and not the special smaller wages that's typically some percentage of the journey workers' wages. And then finally, there's the labor hour requirements. That's the third and final requirement for the apprenticeship requirements. And there it's for construction starting this year or last year, it's 15%, meaning of all the total labor hours on your qualified facility or energy storage technology, for example, you need to have at least 15% of those hours performed by qualified apprentices. In terms of feeling comfortable with compliance with these requirements, I'd say the hardest one, or at least the most onerous to establish or compliance with, is the ratio requirement, because it requires daily reporting. Every day, every time you have a qualified apprentice on site, you need to be reporting daily, are they working in the correct ratio? And so that can just be onerous for those, for reporting requirement purposes. There's also a good faith efforts exception to all of this. That's if you submit in writing to a registered apprenticeship program requesting qualified apprentices, then and they don't respond within 5 business days, then or they deny your request, then you're just deemed to have satisfied the apprenticeship requirements. The good faith efforts exception has a number of specified requirements for that written request, including, for example, the amount or the expected number of hours you're going to need of qualified apprentices. You're well advised to give a reasonable and healthy estimate of those labor hours, because if your request is denied or not responded to, then you use your estimated number of labor hours in your numerator for satisfying the labor hours requirement.
Got it. It's a lot. I guess, Alex, maybe you can share what kind of evidence or other documentation we typically see people provide as, proof of intent to follow these apprenticeship requirements. What kind of documentation are we, seeing used to calculate the ratios, et cetera, in our platform?
For sure. Yeah. And thanks, Katie, for going through all this. And as folks can tell, this is there's a lot here, right? It's very complicated, especially when you get into the different ways that these things need to be measured, right? So ratio, for example, needing to be measured on a daily basis, participation being needed to be measured on a per contractor basis, but also, you could potentially not have any apprentices for, the whole project and then hire one on the last day for an hour, and you would meet the participation requirement. Now, the labor hours requirement would be a separate issue, but the labor hours requirement is going to be sort of across the whole project as a whole. And so I think, measuring all this stuff and keeping track of it, especially in real time, is really difficult. And I think that's one of the reasons why we sort of constructed Reunion PWA the way that we did. And I think it's worth getting into a little bit of the mechanics behind that. And as Connie said, for proving that you're, let's say, compliant with the ratio requirement, we're first going to look at what is the actual prescribed apprentice to journey worker ratio by the associated apprenticeship program, and is that program a actual registered apprenticeship program? And sometimes both of those questions can be a little bit nuanced, or the answers to those can be nuanced. And especially some programs will say that here's a ratio, but there's a graduated schedule, right? So for the first apprentice, you have to have maybe 1 supervising journey worker. For the second, you might have to have 3, for example. So we've been able to construct our platform to be able to handle these different scenarios, and then ultimately to track in real time on a daily basis what what is in compliance versus what is not. And in terms of, something like good faith effort exceptions, of course, there's a list of things like Katie was saying that need to be included in those requests for apprentices. And we will actually provide a sort of a template for folks to use to make sure that all of those things are in there. Because let's say you made a request and you didn't include the number of labor hours you expected these apprentices to perform. Technically, you can't claim a good faith effort exception because you didn't include all the requisite information in your request. And so we want to make sure everyone's, including all the right details in those requests. And then ultimately, what we're looking for evidence in terms of good faith effort exceptions is responses from an apprentice program indicating they can't provide the apprentices that were requested, or response from the DOL or state apprentice agency indicating that there aren't any apprentices in the given trade, something that demonstrates that there was an attempt made and that in fact there are no apprentices that, or fewer apprentices than were requested, that can work in the trade that was specified.
Great. And I believe for good faith effort requirements, we also look into the timing in which the requests were submitted, because that is also a factor in meeting a good faith effort. Is that right,
That's right.
Alex?
Yeah, that's right. Thanks, Connie. And that's the last piece is you do need to submit your request for apprentices 45 days before the start of construction, for when you would like the apprentices to start working, right? So not necessarily the start of construction of the project itself, but 45 days prior to when the apprentices are supposed to be working. And so oftentimes we will see that, the request was made 30 days prior to when apprentices are needed on site, and that doesn't count, unfortunately, right? So there is a timing factor in that, the request for apprentices does need to be made at least 45 days before they're required on site.
Great. And I am seeing a number of questions around apprentices in our Q&A. Some of these we will answer in questions 6 through 10, but a few of them I think we can maybe just tackle now. So I'm going to throw the first one out. If a project hires a qualified apprentice but fails to meet the ratio requirement for the registered apprentice program for all days that this apprentice works, does that impact the participation requirement?
No. No, the failure to meet the ratio requirement only impacts satisfaction of the labor hours requirement.
That's right. And the need to pay them prevailing wage as well.
Yes. Oh, yeah, exactly. So it impacts your satisfaction of the labor hours requirement. And if you try to dogpile 10 apprentices on one journey worker, then the 9 excess qualified apprentices need to be paid prevailing wages and not the lower apprenticeship rate.
That's right. Alex, question for you. How does the platform track in real time compliance with the ratio test when, I assume this is the certified payroll reports or other construction work reports are submitted after the fact?
Yeah, it's a good question. So there are a number of ways that we can ingest data into the platform. There is an integration method that we have where we can actually integrate with payroll reporting systems or LCP tracker, for example. And look, at the end of the day, we're only as good as the frequency of which we receive data. And so if we integrate with a payroll system, then oftentimes, of course, that's about as real time as it gets. The other option is to upload CSVs or to upload payroll reports or other types of PDFs. And so if the data is coming into us, let's say daily or in somewhat of real time, then we have sort of a real time view. Now, in most cases, we're getting data in on, let's say, a weekly basis, and so you might know that a ratio was not met for a week, right? When reviewing that data, or not even reviewing, when entering that data on a Friday, let's say. Now, there's not actually a way for us today to know that, currently today, right now at 10:30 Pacific, that the ratio is mismatched today, right? There's not a way for us to do that. Now, if we were to receive data on a daily basis, right, or a weekly basis, that's the frequency at which we can know. And we do have notifications, automated notifications plugged into the platform, such that if we do see ratio issues, right, or if we do see labor hours issues or participation issues, we will automatically send notifications to the affected contractors and to the developer, letting them know that, hey, this is off, and this is these are the remediation steps. Hopefully that answers the question.
Great. And then a last side question before we move on to 6 through 10. If an apprentice is unsupervised for part of a day, is that okay? Assuming the ratio was met at some point. So I think this is getting to the point that it is a daily ratio test. So in the example of a one-to-one, is there any sort of requirement to line up hours?
The regs are silent on this point. They don't, they just require daily reporting. They don't get into partial daily reporting. I think without more, if at some point in the day they're compliant, I think there's a reasonable position to take that they've met that requirement for the day. But that's a risk. That's a risk that you're taking if you're not in compliance for the full day. But daily reporting is what's required. So kind of interpret that as you will. And I think there's a good position that it means at any point during the day.
Got it. So in the example follow-up question, that an apprentice works something like 10 hours and say a journey worker is only there for 8 hours and it's a one-to-one requirement, they meet the ratio. Is there any sort of additional adjustment that needs to be made for maybe the 2-hour difference between the apprentice and the journey worker number of hours on site?
Again, that's a level of detail that the regs just don't get into. And maybe a good question for reunion, like how you would handle something like that, where you are presented with a fact pattern that's not squarely addressed in the regs. And does it depend on the taxpayer's level of risk that they're willing to take on?
Yeah, I can jump in there. So ultimately, it does depend on the taxpayer's level of risk they're willing to take on. We do have the ability to effectively take a more conservative approach via some setting that we can effectively toggle on and off, where we can basically say, any situation where an apprentice is potentially unsupervised, we're going to consider the whole day as ratio not being met, right? That's sort of the most conservative approach. And then, of course, that would require you to pay the apprentice journey worker wages that full day, as well as exclude their labor hours from the numerator of your apprentice labor hours calculation. More often than not, because as you said, Katie, like the regs are pretty silent on this. We are not checking that box, and most folks can get comfortable with the idea that if there are potentially unsupervised hours, that it depends on their financing party and how comfortable they are. Usually, we don't broach this subject unless there are potentially unsupervised apprenticeship hours, and that's something that our platform does flag, sort of in a little yellow badge saying, hey, there's potentially unsupervised apprenticeship hours here. You got to decide on how you want to handle this. So ultimately, the long and short of it is yes, that it does depend on the taxpayer's risk comfortability.
Yeah, and in the event, there's also a transfer or tax equity transaction behind that. Sometimes it's also based on what the investor or tax credit buyer's risk profile is, and their willingness to accept, indemnity or other kind of reassurance that this risk is not an issue to the tax credit. All right, I think we can move on to the next set of questions then. Job sites across multiple counties. How should I handle PWA compliance for a single site that spans across 2 counties?
I can take that one. Yeah, so you do need to comply with the prevailing wage in each county, including the apprenticeship requirements of each county, and the applicable qualifying program in each county. And I think that could lead to some technical difficulties, obviously, if you're just on a construction site and nobody's even sure where the county line is. Everyone's just, doing the job. And so a couple of things that we kind of suggest people do is either one, pay the higher wages to satisfy both counties' prevailing wage requirements, or two, you could actually request a supplemental wage determination that would be applicable to both counties and applicable to the entire job site. And so that would be another way to avoid the technical difficulties of tracking who's doing what in what county.
And I assume that also applies to apprentice ratio requirements as well. Then you would maybe go with the more restrictive or conservative ratio and apply it across the whole if they were different.
Yeah, that's right.
I think there's also a provision where you can actually use apprentices that come from a different jurisdiction, but you would need to comply with any requirements for the county in which work is performed. So I think that taking the more conservative approach would also address that provision in in the regs.
That's right. And it's possible too that if there weren't available apprentices in one county, that you could qualify for the good faith exception in one county, but not the other, and only need to comply with the apprenticeship requirements in the one county, at least for those specific jobs that don't have apprentices.
Great. All right, number 7, feedback from tax credit buyers and insurers. What are the most common items that tax credit buyers and insurers find are missing in PWA compliance reports?
Yeah, I could take a stab here. So I think we definitely see a lack of data from subcontractors, and the project sponsor doesn't have contract privity with subcontractors, and we definitely recommend having strong EPC language requiring the EPC contractor to interface with the subcontractors and provide all of the relevant payroll data and information that you need for compliance. But I do think there's just technical difficulties and just logistical difficulties in tracking down information from subcontractors, and sometimes that can delay reports or lead to incomplete reports.
Got it. I guess maybe just to chime in on that too, from what I've observed, we most commonly see actually just that the report is not ready because they are trying to fill gaps, usually because they're chasing a subcontractor for additional data. And, as part of that kind of chasing down effort, we are seeing that the industry is, very quickly starting to get, back-to-back provisions and contracts to make sure that whatever you're going to need to report on for prevailing wage flows through the prime contract to all of its work with the subcontractors. That said, what do you do if there is a gap? I think like for example, you just never get wage data from one of your subs. What are the kind of ways you've seen people try to address that and move forward?
Yeah, I'm sorry. So if you just have no data,
If
yeah,
you're
then
maybe just missing like a small subset of data, I guess maybe the example that comes to mind for me is, we have been able to transact even when maybe information from a specific subcontractor was missing, because on the whole, there were enough kind of other good facts about this project that got everyone comfortable with the risk profile and taking the multiplier. It was like union jobs, the union wages were much higher than the prevailing wage requirements. The ratios, the sub that didn't report had very few workers on site. So they weren't subject to participation requirements, for example, because it wasn't someone that had like 10 plus worker or four plus workers. And the labor hours requirement was also, separately met. So at the end of the day, I think everyone had just agreed that, okay, maybe we just move on.
right. And also, I think you can look to the contractual protections in the EPC contract and the creditworthiness of the EPC provider, just to get comfort that if there is a problem, they will cure it and that they're good for it.
That's right. All right. Number 8, making back pay payments. If someone is underpaid, how long do I have to pay them back? Are there any penalties associated with the underpayment? And how can I make sure that my subcontractors are aware of any wage deficiencies and remedy them in a timely manner?
So the prevailing wage requirements requires you taxpayer to pay all the laborers and mechanics prevailing wages. And either you do it or you cause your contractors to do it or the subcontractors do it. If there's an underpayment, then you pay back wages plus interest. That's the short-term federal rate plus 6%. And then when the time comes, you make the penalty payment, which is $5,000 per laborer per year. Meaning that if you have an underpaid laborer who works in December and then does a little bit more work in January, their work has spanned 2 taxable years. And so they are generating a penalty exposure of $10,000 because it's per laborer per year. You can get a penalty waiver if you identify that underpayment by the end of the month following the calendar quarter in which that underpayment arises. So you identify it and you pay the back wages with interest. And the payment also has to be either small in amount or short in duration. So if you meet all these requirements, then you're just the penalty is waived for you. There's also an interesting question here about when do you make these payments? So we talked about like the benefit of identifying and paying it quickly to be exempt from the penalty waiver. But if you blow past that 30-day window, you still have to pay back wages and interest. And the date on which you really must pay it is once the IRS has selected you for audit and determined that you are out of compliance with the prevailing wage requirements and issues you a written notice saying you're out of compliance. That starts a 180-day clock for you to make these correction payments. That's paying the back wages plus interest, and then also paying the $5,000 per labor per year penalty. But until you get that written notice, technically you don't need to do the back wages plus interest. Having said that, if it's not just you and the IRS, but it's you're trying to convince a tax credit buyer or a tax equity investor or an insurance broker that you are in compliance with the PWA requirements, you're going to want to be making these correction payments as they're identified, ideally by the end of the month following the calendar quarter in which the underpayment arises. But you're smart to make these correction payments early and often rather than waiting till the end of that 180-day period after an IRS notice.
Yeah, and just chiming in on that a little bit. Thanks, Katie. There's a lot of these deadlines and timelines floating around, right? And it's really difficult to keep track of them. And I think it's worth maybe just describing how we Reunion kind of handle the the tracking of these things and the notifications of folks, right? I've already mentioned before that our platform will notify individual contractors and the developer of any ratio deficiencies, back pay and underpayment deficiencies, as well as any labor hours or participation deficiencies. And we'll do these on different cadences depending on how likely they are to happen and how urgent they are. But when we do that, we'll automatically calculate kind of the last day of the first month of the quarter after the back pay the underpayment occurred, right? And at a worst case, that's you have 30 days. At a best case, you've got 120 days if you underpaid someone on the first day of a quarter. But when in our notifications, we're going to calculate that for you, as well as calculate the interest owed up through the date that you make the back pay payment, as well as the difference between calculating it from when the day it occurred was. So that's something that we've put a lot of effort into to make sure that folks are all on the same page and that penalties are avoided and that back pay is paid as soon as possible.
Maybe digging into penalties just a little bit further, how are those calculated and how does this all kind of the timing and fact pattern, led itself into an intentional disregard additional penalty?
Yeah, I could take that. So the prevailing wage requirements, they can be cured. One by both paying back wages plus interest and a penalty payment. And that penalty payment is $5,000 per labor per year. With intentional disregard, that gets bumped up to $10,000 per labor per year. The apprenticeship requirements can be cured as well. There's no like back wages concept that just doesn't exist. The only way to cure it is through a penalty abatement, and that's $50 per labor hour. For intentional disregard, that gets bumped up to $500 per labor hour, or sorry, per labor hour per non-compliant apprentice. So for intentional disregard, the regulations set out a long list of factors that are taken into account, including both good and bad factors. Good factors would be things like including covenants to comply with prevailing wage and apprenticeship in your contracts, not having a history of systematic non-compliance with the prevailing wage requirements, regularly auditing your records to make sure everything is staying compliant with the prevailing wage requirements. When you identify something, that you're correcting it timely. And then the examples are really funny because it's like it gives an example of like the most non-compliant taxpayer who does everything wrong on the one hand, and then like A+ student taxpayer who does everything right. And it says one gets intentional disregard and the other is fine. And so it is supposed to be a multi-factor test, and the examples don't really give you a lot of guidance when some factors point in one direction and another point in another direction. But helpfully, there is, you can get a presumption of not having intentional disregard if at the time you're filing your tax return for the year you're claiming the 5 times multiplier, you have made those correction payments, like the back wages plus interest, and you are submitting payment. You're paying in advance your penalty payment with your return. That gives you the presumption of not having acted with intentional disregard. So I would say paying your penalty with your tax return is an early payment because technically that penalty payment isn't due until you get selected for audit and the IRS determines you're out of compliance, and which starts a 180-day clock, and you haven't paid that penalty by the end of the 180-day period.
Got it. And a question from the audience, is the $5,000 penalty per worker per year per project, or is that somehow applied across all projects?
Per project. Right. Yeah, it is. So, and we'll get into this in question 10, but the PWA requirements are drafted at the level of your qualified facility or your energy storage technology. And that is the unit at which you are establishing compliance. And so that it is per labor, per year, per qualified facility.
Thank you, Katie. And then I think kind of segue into number 9, demonstrating intent to pay penalties. If I have PWA penalties due and intend to pay them with my tax return, how should I document this intent for purposes of demonstrating my project's PWA compliance?
Yeah, it's demonstrating to whose satisfaction. I think for purposes of number 9, this presumes that you're a taxpayer who needs to convince a tax credit buyer or a tax equity investor, somebody other than the IRS or your tax return preparer, that you have complied or intend to comply with the PWA requirements. And I think that's where Reunion probably can step in and speak to the type of compliance reports you provide and how you address instances of non-compliance.
Yeah, I can speak to that, or Alex, if you'd like to. In terms of what we've seen on live transactions, sometimes it's just a letter of intent, saying like we own that we have these amounts due, and penalties that are going to be paid with the tax return may not have been paid because you're waiting on the transfer to be complete before you're filing your tax return. So sometimes there's just a letter of intent clarifying, and it's maybe coming from a developer with a good credit profile, and so there's not a lot of perceived risk. In other situations, we've also seen cash escrows set up just to kind of also tie off the risk that maybe someone hasn't set aside the funds needed to make the payment, and depending on if it's like a partnership entity that maybe is a little less well capitalized that needs to make the payment, just making sure the funds exist at that entity level for when it files its tax returns. Yeah, we've seen escrow set up as well. Alex, was there anything that you would want to add to that?
No, I think that covers it. Yeah, it's effectively, the letter of intent, potentially putting that cash into an escrow account, and then ultimately in the way we do our compliance report is, if there are penalties due, that we consider having the intent to pay the penalty with your tax return as, as good, right? We're gonna call that penalty covered, and for purposes of assessing PWA compliance for the project, we will consider it compliant if any penalties that are due have a letter of intent behind them, and/or a cash escrow account where we can reasonably get confident that these penalties are going to get paid, and then demonstrate that to a tax credit buyer or insurer.
Great. All right, last question. The definition of a qualified facility under Section 48E, and I think, Katie, you were already alluding to this, but if my project is pursuing 48E tax credits, do I need to track PWA compliance on a more granular level than the project as a whole to comply with the definition of a qualified facility under 48E?
Yeah, this one is a headache. So 48E is different than the legacy 48 credit. Under legacy 48 ITC, you would establish your compliance with PWA at the level of the energy project. Energy project, much like a single project, it's composed of all your little different energy properties. And so you look at your project as a whole, have you comply with PWA at the whole, yes or no? 48E instead requires establishing compliance with PWA at the level of your qualified facility. Preamble to the final regs say for solar, for example, a qualified facility is your string of modules connected to an inverter, what I'll call just an inverter block. Meaning, technically, you're supposed to be establishing compliance with PWA on an inverter block by inverter block level. So for example, if you taxpayer have 100 employees to go build your solar facility, and your 100 employees include 15 qualified apprentices, things are looking good because you think you can satisfy your 15% labor hour requirement, your participation requirement, and your ratio requirement, and you're going to pay everybody prevailing wages. Under old legacy ITC, chef's kiss, you're in great shape. But for 48E, technically, you're supposed to be showing compliance with all those requirements at the level of each inverter block. That means 15% of your labor hours on an inverter block have to be by qualified apprentices. There is such a tension between what is required for tax purposes on the one hand and what is commercially feasible on the other hand. EPC contractors are saying, we hear you and we can't do it. That's insane. Like, we're just not going to do it. We don't have that level of detail. And that puts taxpayers in a really hard spot. And I think the solution, where like all these taxpayers have the same problem, and I think the solution that the market is revolving around is to do a reasonable allocation method that's showing compliance at the project level and then reasonably allocating these different components to each level and establishing satisfaction at the level of each qualified facility based on a reasonable allocation. Having said that, in the preamble to the regs, the IRS considered commentators' request to establish compliance at a group level, like an elective grouping, the commentator says, and the IRS specifically says, no, you cannot review PWA at the level of the entire project because that's just not what the code says. And we, IRS and Treasury, do not have the power to bless compliance at a level other than the qualified facility. And so, what do you do? Like, what do you do? Like, literally, if contractor is telling you they can't show compliance at the level of a qualified facility, I think you're entirely reasonable and you're in good company to do the reasonable allocation method. Show that you've paid prevailing wages on a laborer by laborer basis. So at least you can satisfy that. And then kind of stand ready to make cure payments if the IRS, if you get selected for audit and the IRS determines that you're out of compliance, then at that point you probably just need to admit defeat and then pay the cure penalty and that for the failure to comply with apprenticeship, and then you're back to being eligible for the 5 times multiplier.
I think the last thing I'll add on that is, the way that Reunion has sort of gotten comfortable with this with some of our customers who are trying to comply under 48E is via the reasonable allocation method, and specifically the method we've utilized is effectively weighting the total project labor hours across each individual inverter block by each inverter block's size in megawatts, right? And that's something that our customers, their counsel, and our counsel have gotten comfortable with. But as Katie said, there's still a lot of gray area here, and I think we're all trying to do the best we can with this specific issue.
Yeah, and maybe just a reminder that the 48E is only available for projects that began construction after 12/31/2024. So still kind of a lot of those projects are still early in the process. But I do think this will be an important and difficult issue for folks to solve going forward.
That said, I think we can turn to a few more questions that came from the audience, if y'all don't mind. I'm just kind of skimming through, and feel free to pick a couple as well. I think the rest of the panel can also see the questions. Let's see. Can a tax credit buyer in a transfer be held liable to pay the penalty by the IRS if the seller hasn't made the payment? I think that's a good question. I don't know that they would be held liable, but if the payment's not made, the multiplier presumably could be in jeopardy.
Right, you'd have a reduction of the credit amount that's available if it's not paid.
Yeah.
So but they couldn't. So you'd have basically a recapture of that portion of the credit, which could actually be worse, worse than being liable for the payment, because it's probably the payment's probably much less than the loss of credit, the value of the lost value of the tax credit.
Yeah, absolutely. The person responsible for making the cure payments and the penalty payments is the eligible taxpayer, the selling taxpayer. And so the IRS puts it to that person to make the cure payments, make the penalty payments. And if they don't within that 180-day period, then you just don't get the 5 times multiplier. And the impact of that is then addressed in the tax credit transfer regs.
All right. How long is the Department of Labor typically taking to respond to conformance requests? Not sure if there's been an observable backlog due to the recent shutdown in terms of the 30-day limit to respond. Not sure if the panelists here have seen any additional delays.
Yeah, the 30-day period, that's making reference to the fact that once you submit a supplemental wage request, you're expected to get a response within 30 days, or at least acknowledgement of your request, and that they need more time. And it's entirely foreseeable that the shutdown is going to slow down that time period. It doesn't impact the rule that you're still allowed to pay retroactively without interest your laborers and mechanics. Once you finally get your supplemental wage determination, you can just pay it to your laborers and mechanics retroactively without interest and without penalties.
All right. And in case this is helpful, I have seen the acknowledgement letters and a number of projects actually still waiting on a final, determination or response. So not sure what the timeline ultimately is at this point, but we have seen at least the acknowledgement letters on a few transactions that are still kind of waiting. How is PWA compliance actually audited, and by whom? At what cadence? Is this something that the IRS is like routinely doing, or is it the Department of Labor?
I would say the IRS. One thing in drafting the regulations, there was a conscious effort to make all of the substantiation and all of the compliance not due until tax return season, or until it's time to file your tax return where you claim the 5%, or sorry, 5 times multiplier, meaning there's no front end obligation to submit prevailing wage requirements or apprenticeship compliance to the IRS in advance. You really don't have to show the IRS or tell the IRS anything until you file your tax return claiming the benefit of the 5 times multiplier. Then you're selected for audit, and then the IRS exam is going to audit your PWA compliance. And then to your question, is it in consultation with the Department of Labor or just the IRS? I'm not sure about that.
Yeah, I think a lot of the audits are still forthcoming, given, that a number of projects were grandfathered under beginning of construction rules, and just the timeline in which the final rules were or regulations were issued. I think just a lot of kind of the audit stuff is yet to come, and I think we'll get more clarity along the way. That said, I think we are at time. There were a number of questions that we did not get to, even though I tried to squish some of them in. But thank you all so much for joining us today. As I mentioned before, there will be a recording available and a transcript of our webinar today. And I think on the screen you have our contact information as well. So feel free to contact us if you have follow-up questions or you're looking for legal assistance with regard to PWA or just your projects in general. All right.
Thanks,
Thank you
everyone.
all.
Thank you.
Thank you.